the coronavirus is something which is going to be having very large economic ramifications. I don't remember when was the last time this kind of a capital infusion was done by any central government because of a virus or because of what's happening. So I think coronavirus, unfortunate, sad. I hope it gets contained. Unfortunately, the news over the weekend does not seem to indicate that we've reached the peak of it. But we are discussing economics here. And the economic impact, I think, of that is going to be very large. You know, it's like saying demonetization when it happened in India, the economy took a slump. I think the same thing is happening in China.
Yeah, and the effect is felt months after the actual event. In fact, let's chat about all of this a little more. We've got online with us Hugh, head of Asia Pacific at Aberdeen Standard Investments, joining in on the show right now. Hugh, hi, morning. We'll come to the India budget a little later, but just looking at the global screen right now, you think the global market panic is justified, Hugh, because of the coronavirus? And could it really be the contagion that everyone's fearing right now?
It's very hard to say, to be honest. Understandably, people are panicking a little, certainly as far as markets are concerned, but that has to be taken in context of markets that have been exceedingly resilient for quite a few years now, quickly shrugging off fears of trade wars, higher interest rates, etc. So I think it's quite understandable in the circumstances, and in one sense it's a good thing, and it's a good reminder that markets go down as well as up. Will this be a huge pandemic, the like of which we haven't seen in our lifetimes? Who knows? Certainly the authorities around the Asian region and worldwide are taking quite extreme proactive measures, which is very positive. And there's certainly not that feeling of panic that we saw during SARS. People are being a lot more rational, but one never knows. And of course, fear and greed are the things that drive stock markets, and we're seeing a bit of fear at the moment.
Hugh, are we looking at a serious downtick in global growth? Do you think this is going to be a tough one for emerging markets to navigate? Because China slowing down means world will slow down, and that clearly will have implications on the way how emerging markets will move for 2020.
Absolutely, and we certainly had already been seeing economies quietening a little from our contacts on the ground with corporates and the like, even before this. So this is certainly going to have quite a bad effect, again, depending for how long. I mean, at the moment, things have pretty much shut down in China. Our office, for example, remains closed for another week in China, and we'll see at the end of the week whether it reopens. So things have gone very, very quiet in China. Things were already slowing in China. Maybe this brings growth in China down to the 4% level rather than the 6% level. But again, it's far too early to be absolutely precise about the effects, and they could still well be very short-lived.
Hugh, coming to the budget then, and what we're seeing in India, we had one of the largest single-day falls, as you know, on the weekend, as we digested that budget announcement amidst all the global concern around coronavirus. From your perspective, are you happy that they've removed the dividend distribution tax and you'll possibly have to pay less tax on your... I think that says it all.
Well, the budget certainly wasn't all negatives, and the removal of the distribution tax is a positive. A bit of opening up of the corporate bond market is certainly a positive. But it, in many ways, confirmed what has been very evident in India, that the economy is not really firing on all cylinders. There's still not a massive deficit, but certainly a deficit that's a lot bigger than the authorities were hoping for. So there, in many ways, I would say the budget was a bit of a non-event. Certainly not a massive negative, but maybe not as expansionary as the optimists would have hoped.
Last time when we interacted with Aberdeen, the house view was that Indian stocks were reasonable, but they were not attractive. Given that economic indicators have now started bottoming out and there is going to be growth problem in China, would you prioritize investing in Indian stocks over Chinese stocks now?
Yeah. Well, we like both India and China long term. India has long been one of our favoured emerging markets for obviously the growth potential of India that arguably India never quite achieves the full potential that we'd all wish, but certainly the underlying quality of Indian companies remains very high, and at least on a par with, if not better than many of their Chinese counterparts. So we do like India. Our fundamental concern with India, I'm afraid, has always been valuations. The growth for corporates has not been coming through as strongly as we would have hoped. And at the same time, the valuations of the good companies in India have tended to be towards the high end of the spectrum. So really, we've been looking for that growth to justify the valuations, and that growth has been deferred a few times now.
You know, one of your fantastic calls over the decades has been that you've bought private banks and you've not sold Indian private banks. I mean, that's some conviction, and that is something which has handsomely rewarded you. So if Aberdeen has to identify a high growth sector for Indian markets for this decade, when I say 3 to 5 years, where to your mind there is scope for high earnings and strong P re-rating?
I think as far as the PE re-rating is concerned, that's hard to say, simply because the PE ratings of things like the private banks, we still think have that scope for growth, like, for example, paint companies that we've held for 20 or more years in our portfolios. It's very hard to argue that their growth is going to be really tremendous to justify a re-rating upwards. I think what we need from them is just that growth to justify the rating they're on today, and providing the growth comes through, if it comes through at 10, 15, with a very, very fair win, 20%, then that will justify current ratings, and you can see share prices move in line with earnings growth, which in a global sense is still a very reasonable return for investors.
Be tempted to add more to India and the stocks that you already hold, if indeed in this fall the valuations become at least close to ripe?
Yes, again, we're looking at that, but everything seems to be falling at the moment. So in a portfolio sense, in India doesn't stand out relative to elsewhere. We're seeing China down very sharply today as it reopens, with quite a few stocks limit down. There's maybe more immediate attraction in the very, very short term for those who are more trading oriented to top up China rather than India. But for us, India still remains such a core part of our Asia Pacific and our emerging market portfolios, and that's not going to change.
I know, this is the last question, as a policy, you've shied away from buying PSU stocks. It's not that you've not bought PSU stocks, you've shied away from buying PSU stock. But if LIC IPO comes at a reasonable price, can I assume that Aberdeen would be interested?
Yes, I think we'd look very closely. You're right, we have shied away from PSU stocks, and we've always really preferred the private sector, where maybe interests are better aligned and managements are more efficient. But again, we look at everything.
Really appreciate your time, and thank you for accommodating this interview request.